Hey guys, Jeff with OptionBoxer.com back again with another strategy video-ish. Before we get into it, please know I'm not a registered financial advisor, and this video is not a recommendation for you to buy or sell any security or place any trade or attempt what I'm going to show you here. I want to go ahead and look at this spreadsheet. I had some time tonight and I was just kind of bored, and I wanted to take a look at my portfolio. In the last video I made, I kind of shared with you, kind of opened the door to the stocks that I was holding and a number of the things that I was doing and how I was going about trying to improve my performance consistently and over time. And so I wanted to take a look today at the options income along with the dividend income and just see how that might compound over time. Now, I should probably tell you before we get started, this is all hypothetical. The options income may not be realistic over the course of time. It's realistic as of today, or I'm sorry, as of yesterday when I started this spreadsheet. I didn't update it for the market fluctuations today, but it's updated as of yesterday, so on 12-12. And so it's more or less realistic as of right now. Now, volatility may change, of course, and we'll look at that a little bit here in just a moment. Open interest may change, the premiums may change, so a number of these things are hypothetical. There's just no good way to account for an endless number of variations to the what the options premium could be. But what I've got here, so I've got all the stocks that I currently hold. You can see them there on the screen. They're all stocks from different sectors. I have differing amounts. This is not the number of shares I have for each of these. I just wanted to look at it more on a general basis. If I did have 100 shares, so that I could start to sell covered calls or sell cash secured puts to start making some income. But really, this only accounts for covered calls. It doesn't account for any put income I may also receive. It's just looking at certain the 30 or the 50 delta options contracts. But these are all the stocks that I own, and I just wanted to look at it. If I had 100 shares, I started out when I started the spreadsheet. I just wanted to see how much would it cost, how much money would I need to have to own 100 shares of all the companies that I like, or the companies that I've purchased, or that I like today, I should say. Tomorrow I may feel differently, or you may look at this and say, man, you're an idiot. What are you doing owning NRG? If you've watched NRG recently, that thing tumbled. So not the greatest, but regardless, these are the companies that I own. If I owned 100 shares, it would cost me a grand total of $271,000 to own 100 shares at today's cost of all of these different companies. Now, many of them I don't even own double-digit shares. Many of them I only own 2, 3, 5 shares. And so it would take me a long time just based on the amount that I'm able to save to get to this point. But if I did get to that point, I just wanted to kind of see what it would look like. And so what I did, so once I got through with this, then my mind kind of, trailed to the next step, and that's which one offers me the best bang for my buck. Which one, if I owned 100 shares of Intel, well, I'm getting, if I sell the 30 Delta option, I'm getting 22% versus, if I bought Coke, 100 shares, that would cost me $6,395, and I'm only getting 12%. So you factor in the dividend yield and the 30 delta option yield, and 12% is a lot less than 22%. So then I wanted to see, well, of the companies I have, which ones are really offering me the most value if I had 100 shares and I was able to collect the options income as well as the dividend. And so what I've done is I've highlighted those. I've taken and I've just done the math here to give me a total at yesterday's price per share, to give me a total for 100 shares of each of these. I've factored for the yield, the amount, the dollar amount per year on that yield, the 30 delta as of yesterday for Coke was about $53. I also wanted to take a look at volatility, so I'm going to pull Thinkorswim on the screen so we can look, and let's look at Intel, because Intel is one that I've already started to collect the number of shares on. I think I have 30 something, 34. So I'm working my way up to 100 so I can start, collecting some options income there. But let's take a look at Intel. Specifically, I want to kind of focus on volatility. So all of the dollar amounts you see here on the screen, the 53, 41, so forth for the 30 delta, all of that was about 30 days. So I've accounted for that in the options yield column here. You can see I multiplied it by 12. All of them, assuming every 30 days I could get that amount. Again, that's a big assumption, but it's an assumption I wanted to make just for the sake of this spreadsheet or for this video. And so for the 30 delta, and I also, like this, in this instance, it was 36, I'm sorry, a 36 delta, I went to the delta just below it. So it would actually be maybe a little bit more profitable than I'm accounting for here with $36. But I think, let's see what it looked like yesterday. So it was a little bit more yesterday. So about 30 deltas, give or take a little bit. I always went to the one just below whatever was the current 30 delta as of yesterday's market. Now, of course, prices changed a little bit today. Volatility has changed a little bit today. So the numbers, again, hypothetical in nature. There's no way to account for all the different variations that you would experience over the course of a year or a day, really, much less a year or 10 years. So you can see IV is or the IV rank is at 25%. And basically what that's saying, to my understanding, I know there's been a little bit of conversation on my website about IV rank versus IV percentile. My understanding is, looking at this number, and I don't complicate it, you may look at it and say something different, but the way I see this is over the past year, IV has only been this low 25% of the time. So 75% of the time, implied volatility is actually higher. And if implied volatility is actually higher most of the time, then this premium should theoretically be higher as well. And so that's really all I use it for, but it gives me a good indication or a good sense of, is this 41 cents, or this $41 for the 30 delta, is it realistic over a longer time period, like over the course of a year? And in my opinion, it is. So looking at that, I feel even maybe a little more confident that the 22% could hold up, over the course of a year or even longer. Now, Intel's in a little bit of a downtrend, so they're not the most ideal company, I guess, at this moment. But it does get you 100 shares for a relatively small cost of $2,800. All of our lives we've heard you got to diversify, you've got to have index funds, you've got to have ETFs, and all the different things we've heard over the course of time. And I've got that. I've got every different sector accounted for. I've got some index funds in here. I've got some large caps in here. I've got some income generators in here. I've got, what else do I have in here? I've got some small caps. I've got mid caps, I even think. I've got just a wide variation. I've kind of cast a wide net with the way I built this portfolio. I've got some companies that aren't really great at generating any dividend income, maybe a little better at generating options income. But really, Texas Roadhouse is one that I like over the long term. I think they'll continue to grow. Nike's another one. I think they'll continue to grow. Again, don't produce much in the way of dividend yield, but I think over the course of the next 10 years, we'll watch them continue to grow and maybe even split their shares a time or two along the way. But the bottom line is, we've been told that all our life, that you have to have a diverse portfolio, and that way if the energy sector is going up, consumer discretionaries is going down, and that way you kind of smooth out the volatility a little bit over the course of time. But I got to thinking about, well, if I could sell the 30 delta option and I could collect the dividend income, what would that look like? So I factored in for the ones that, offered me the most return. And if you look at all of them, not just the ones I have highlighted, but if you look at all of them, that calculates out to, you can see the formula I used to get to that. I did a sum product where it basically just multiplies the percentage return by the total amount invested to give me 40,000, and then 40,000 divided by the total amount that I put into it gives me a yield of 14, or a total return of 14.91%. And so 40,000 on 271, it's not fantastic, but it's certainly not bad. 40,000 is better than nothing. But then so I wanted to carry it on a little bit further, because 30 delta is kind of where when I sell a covered call, it's kind of what I identify, just because I want to give myself a little bit of breathing room. So if the stock does go up, generally speaking, I want to keep the shares so I can continue making income on them. And we'll look at a number of different notes and caveats at the end of this video. But I generally want to keep the shares, so I want to give myself a little cushion for capital appreciation. But then I considered, well, what if I don't want the capital appreciation? What would that return look like? And you can see the figures are considerably larger. Over here it was 21%. I've added 33% on that in that instance. Intel was even stronger at 52%, because obviously the 50 delta is going to get you a higher premium. For Intel right now, it looks like for 50 deltas, and again, same thing as I did on the 30 delta. If it was at 54, I just went down to the lower delta value. So 108 Yesterday it looks like it was 114, but you multiply that by 12 and you get 47%. You add in the dividend yield and you get 52%. So 52% return over the course of a year is staggering. I mean, that's you just basically, you didn't double your money, but I mean, that's a return that's unrealistic, really. But while it's unrealistic to think you could have a 52% return, the income numbers won't change. The only number that could change would be this total amount that you've invested of $2,868. That could go down. You'll still earn the 52% or whatever the number may be. You'll still earn the 41 times 12. I'm sorry, the 114 times 12, which would be $1,300 or so. You would still earn that, but if this number shrinks by 1,000, you really only profited $300, and so that's something else we're going to look at before the end of this video. Also, the last thing I did is, with the 30 delta, I wanted to just see what the total value would be for, if I sold the 30 delta, if price did go up to that strike price, how much would I be able to add to the position or add to my total value? Because it's part of the total return would be that capital appreciation. And so in this instance for Intel, it would be $226 roughly away from, again, theoretical or hypothetical, I should say, $226 away from in the money. And so that would be an additional amount of money. And that's only assuming that I did that one time per year. Intel could go down below or, could go lower and I could sell a 30 delta and it could go up and breach it. And then I buy the shares again, it goes up and breaches it. So this number is really just a shot in the dark. That's only assuming it breaches my covered call once per year. The reality, again, like I said, is this value could go down and we would get to keep the total income, but we wouldn't see any of this gain. So again, just theoretical, and it's just more or less just playing with numbers and creating storylines more than anything. But if you factor in for all these 50 deltas, it comes out with a total return of 31% or 84,000. Again, 84,000 on top of 271 sounds really good, but if this 271 turns into 220, we're only really making 20,000. So it's a shot in the dark. It's a roll of the dice. You don't know how the market's going to work out. But the biggest way that I found that I believe that you can mitigate that risk of this 271 shrinking into something considerably smaller, and this is very important, the biggest way is to buy companies that you believe in. Intel's not going through a good time right now, but that's largely because AMD has kind of shined here for the last few years, and it looks like they'll continue to shine for a little bit longer. But Intel is still one of two companies, in my opinion, that are the top of the top. They're the top companies for their market, their products. I don't know how to say that. They're the top companies. AMD and Intel, they make computer processors. Along with a number of other things. Intel actually just also got into the GPU market, which has been just on fire the last 5 to 10 years. So all in all, while Intel may not be looking the best at this moment, I still think they're going to be around for the long haul. I don't think AMD is going to just wipe Intel off the map. I think Intel will make different business decisions that will make them more profitable and more attractive from an investing standpoint. But if you're looking to get into them like I am, or if you think that they'll be around long term like I do, then we're able to buy our shares. You can see I bought them at an increasingly lower price each time I've purchased them, and I've been pretty much kind of collecting 3, 4 shares every chance I have some money to get, so that way I could get to 100 shares and start collecting the options income as well. But anyways, I've kind of gone through all of that, so now I wanted to just take the companies that I've highlighted as the most attractive from an income standpoint and pull those out of the market, or pull those out of this sheet and look at those individually. And that's what I've done here. And we'll get to the notes section here in a minute. So basically what I've done is I've calculated, or I've taken all of the data from up here and just kind of combined it, or aggregated it here. And you can see the total return. So if I bought 100 shares of all these companies, first thing to notice is I wouldn't have to have 271,000. I could do it with 35,000. If you looked at my account balance, you'll know that I'm getting really close to a position where I could do that. Now, I probably won't do this specifically, but theoretically, you could build a basket of stocks that were similar to the ones I've got here that offered you a nice 30 delta return and a dividend return to get you to some of these numbers. and you could build a nice diverse basket even that would offer you an attractive return, but they would be good companies as well. Intel, I think, is a good company. Dow, I'm a little shaky on. You may have to alter this. I think Dow's in the materials sector. NEM, I think, is in the materials sector. Nike's consumer discretionary. This Chemours is also in the materials. NRG is in the energy sector. Citi's in the financial sector, and then ET is in the energy sector as well. So you would have to kind of create a more diverse basket, but just for the sake of this spreadsheet, just for looking at the numbers, I wanted to just pull those out and look at them specifically. So the first thing to notice is it would only take $35,000 or almost $36,000. The dividend yield on that $36,000 would be $1,332. The 30 delta options yield would be $7,344. You add this number and this number together, that gives you a total of $8,676. That, of course, is a 24% gain on this $35,000. So just a shocking gain. Now, again, this $35,000 could shrink, and for all intents and purposes, it probably will, as the market fluctuates up and down. But if you believe in the companies that you have, then you believe at some point it will come back, and which means you can take your focus off of the kind of the core invested amount or the core cash value a little bit. I mean, maybe not completely, but you can kind of take your eyes off that a little bit and just focus on the return or the income generation that you're earning on the amount that you have invested. And so in this case, it looked like 24%. Again, if this shrank by $10,000 and I only had $25,000, well, my net profit would have been nothing. I would have still put this $8,000 into my account, and if at any point that $25,000 came back to $35,000, well, then this $8,000 would look a lot prettier, obviously. But the point is, I made 24.18% on this money that I had invested. If I add in, if all of these stocks went up to, if one time throughout the year, all of those stocks went up to the 30 delta option, and I had to sell the shares at the 30 delta strike price, I could actually turn that into 11,000 or 31.3%. If you look, I'm not going to go through as much of the math with the 50 deltas, but if you wanted to really skyrocket your income return, you have to assume that anytime you sell a 50 delta option, you're more than likely, let's take a look here again, you're more than likely going to get assigned. If it goes up even just a small amount, in this case 27 cents, if it goes up 27 cents per share, which it can do in a day easily, it's going to be in the money, and you're likely going to get assigned. But if you're just looking at it from an income standpoint, you would skyrocket your income. You would create, instead of 7,000, it would more than double it to 17,000. Add in the dividends, and you got 18,000, or a 52.17% return. So it really kind of makes sense to do the 50 delta if you're not worried about the good companies that you've created the basket of. Or even if you wanted to just do this with one company, you can see Energy Transfer Partners, I think is the company name. You could do this with as little as $1,100. Now, ideally, I wouldn't want to put too many eggs in this one basket, because you don't know what the options market will do, or you don't know what Energy Transfer Partners might do. They may not be a great company long term. They may only be attractive right now while the energy sector is hot. But it's there, and it can be done with companies that you don't have to have $50,000 or $100,000. You can start this process today and start earning this income, and then over time, as you're able to get more of that income, you can separate and diversify into other good companies that you believe in. But what I want to do now is I want to take these numbers that I've created here, and I want to look at them in the context of a compound interest calculator. So it's nice to see that, and yeah, we feel real warm and fuzzy when we see a 24% return. But what does that look like over the course of time? And if you felt warm and fuzzy just seeing that there, you're going to really feel great when you take a look at it in this context. So let's see if I can get both on the screen. So let's say we invested $35,886. We bought 100 shares of each of these companies, and we invested $35,886. Our total return, if we don't add in the capital appreciation, would be 24.18%. So let's say we have a 10-year time horizon. We're not going to add anything else monthly, at least not yet. We'll look at the numbers here in a second. But we wanted to factor in for 24.18%. Okay, I'm not going to look at an interest rate range. That would be if we wanted to look at like 14% all the way as high as 34%. I don't want to do that at this moment. This would actually compound itself monthly, but we're just going to look at it annually. It's a little bit lower return. But if we calculate that, you can see we took 35,000 over 10 years, didn't add any more money to it. We just took the money that we had. Again, the numbers won't change. The only number that could change would be this 35,000. And so if you bought into poor companies that would never hold their value, Intel's $28 today. If 5 years from now Intel was down at 18, well, then these numbers won't make sense. They're not realistic. But if you believe Intel's going to be here in 5 to 10 years, and you believe that they would possibly even trade higher than $28 a share, then everything you see here is realistic. And so we could take a small amount of money, $35,000, don't add anything else to it. Over 10 years, it would turn into $312,000. Now, more than likely, you're going to take that $35,000 and you're going to add some amount to it each month. Let's say you're able to save $200 per month. That's not, I don't think for most people that would be excessive. I think if you budget properly, adding $200 a month to your investments wouldn't be unrealistic. So that can take it all the way to $389. So that added another, 40,000? I can't remember. Let's take that out again. I can't remember what the amount was. So it added another $70,000 just by saving $200 a month. Now let's say you're able to save $500. Let's see, what would it take to get to $1 million? So $500 a month gets you to $500,000. What's interesting to note before I continue on here is on that $500,000, the last year, between years 9 and years 10, you made over $100,000. So at this point, maybe you're looking for a lifestyle, a life of luxury or a life of rich and fame. I'm not personally looking for that. I could live very, very comfortably on $100,000 a year. And as long as I believe that my companies at that point 10 years from now would still be there 10 years after that, I could really stop contributing money to the market and just live on or go and do whatever I wanted to, because $100,000 a year, I can not only pay for all of my bills, afford a decent home, afford a decent vehicle to drive. I mean, I could have really the nicest things I wanted on $100,000. My salary right now is not six figures. So if I was able to make $100,000 a year passively, just incomes, clicking a few buttons on a screen, that's to me, that's a win. That's everything you're looking for. But let's just continue on. Let's see how much would it take to get to $1 million. Let's say you doubled that. Let's say you were able to save $1,000 a month. That gets you to $696. Let's double that. Let's go to $2,000. So if you're able to save $2,000 a month, that would take that $35,000 and turn it into over $1 million. Over $1 million. Let's look at the table. Between years 9 and 10, you would have earned 300,000, essentially 330,000, if my math is correct there. Maybe 230, 250 something. I don't know. I would have to add it up. But you contributed a total of 275,000 over the course of time, and you earned $1 million. And again, let's just add one more year to see what you would make, just because we're playing with this. Let's add one more year to see what you would make that final year. And you see it went from $1,079,000 to 1.3. So you would have earned another 200 to 250,000, or I guess 200,000, another 200,000 in a year. And if you can't live comfortably on 200,000, then you really have no business watching this YouTube channel, because if I could make 200,000 a year, you would see way more videos from me, because that's all I'd be doing is just making videos, just having fun. But you can see the contributions would be relatively low compared to what you have, and then you would still earn that income. Let's assume for a second we were able to get the 31.3%. Let's say we did one time each year, these companies went above the strike price and we had to sell the shares at the capital, with the capital appreciation. Let's say we were able to get 31. Let's take this back to 10. Let's take this back to 500. I think 500 is probably a respectable amount for most people. Let's see what that puts us at. So in 10 years, we took 35,000, added $500 a month, which I believe if you invest right, you have a job that you are happy with and that you can continue to do peacefully. Obviously, there is something to be considered. If you're in a job that you hate, you're not going to be able to sustain a savings plan, because you're constantly fed up and tired with your job. So it has to be something that you're at least tolerable of. But in 10 years, you could earn $800,000. And if you look at that, in the final year, you earn 200,000 in the final year. 619 to 819, 200,000. Really around year 6 or year 7, you could probably start to think, hey, I'm going to step away from this job I hate because I've got enough income passively that I can work as I need to pay the bills that I need to. Or if you don't want to continue to grow your account, just live off the passive income. You travel the world, whatever you prefer to do. For me, I have, big dreams of someday being able to just hop on a plane and fly across the country just to see what it's like, and then hop back on if I hate it and come back home. And, maybe I'm wrong in that, but that's my dream. And so you can see here how the numbers change. And let's just, for the sake of this video, let's say you saved 0 over the course and you were able to earn this 52%. Let's see what that looks like. Just insane. So just taking the dividends and the options income with a 50 delta, you could take a small $35,000 account over 10 years. I'm not talking about when you're 65 and you're too old to care. I'm talking about if you're 30 right now, when you're 40. I mean, yeah, you're not going to be as young as you are now, but you're going to be still healthy enough, still active enough, still able to do the things that you want to do, and you're going to be making an insane amount of money between the final on the last year. You earned almost 800,000. Again, just a shocking amount of money, and all of this is again hypothetical, but it's just fun to look at and it's kind of fun to play with. And the big thing is this amount that you have invested, is that going to shrink? If that shrinks, then of course things change. And if it shrinks and never comes back, then of course none of these numbers make sense. You'll never be able to get to 2 million or 1 million or 500,000, because the amount of money that you have to collect that income on has deteriorated. But I also want to just look at it for the sake of doing so. You can see I've kind of calculated it here where, over time, if you were able to buy more shares, well, the percentages don't change. The only thing that changes is the amount of money. So if I had 1,000 shares, well, let's say 900, because I didn't factor in for the second digit there. The percentages don't change, only the amount that you collect in income changes. So if you had 900 shares, it would cost you 322,000. But this is only looking at 1 year specifically. That year you would make $100,000 on that 322,000. So again, at this point, however long and far into the future it would take you to get to 300,000, you would make 100,000 on that account with this, with these particular companies at today's numbers. Again, nothing's to say that this options premium will hold over the course of time. Nothing's to say that volatility won't collapse or change. And you instead of getting $369 for Intel per year, you may only get 169. Or if volatility increases and ramps up, you may get 569. So this 24% may actually be 35% or 50 or whatever you want to account for. Again, is an endless number of variations. But the final thing I want to do is I want to look at and you'll see I didn't calculate for the 50 deltas, so the percentages didn't change or didn't match up. So I didn't do the calculations for those to account for different shares. So you can see if I take it back down, it goes to 52. But if I did the calculations, it would stay at 52%. The only thing would change would be the dollar amount. So a couple of notes to kind of look out for, and what I've already kind of talked about, we'll touch on them again. Look at volatility. So we did that at the beginning. Look at the IB rank, see where volatility sits right now. Intel kind of high, but over the course of the last year, you can see, because the last year we've basically been trading downward. Well, Intel's volatility has been higher a lot of the time. Now, next year, Intel may level off or even start to trade higher, and so these numbers may decline considerably. We just don't know. You also want to look at the liquidity. So what I mean by that is you want to make sure the open interest is there. This is a non-typical expiration month. So if you got on a schedule where you were trading the more typical expiration months, well, you can see open interest is through the roof. You'll never have a problem getting into or out of a contract. And so is there enough open interest now or in the future? If you want to kind of get an idea, if you want to kind of get an idea of what the historical open interest is, you can use Thinkorswim's Think Back tool, and you can dial back. Right now I've got it in January 2020, and you can see open interest is still pretty good. Back then they only had 250 wide strikes, but you could still identify somewhere near the 30 delta, and you can see it's 6,000 open interest. That's not, it's not a staggering amount. There's not just an insane amount of open interest there, but it's enough for you to be able to get into and out of a trade. And so liquidity would be good on all of these stocks. I checked the liquidity on all of them, and they would be fine. ET would be the only one that I would have a little bit of reservation about, but the amount that you would invest in it is so small that it's really almost kind of foolish not to if you have $35,000 that you're looking to invest. Why is 30 delta better than 50 delta? Is the total, and so I asked that question to myself and kind of presented it to you. Is the total appreciation higher for one than another? Do you want to keep the stock? So realistically, if you want to keep the stock, you would probably want to avoid the 50 delta so that you didn't have to continually buy in at a higher cost. So if you bought the 50 delta and price went up from 1170 to, let's say, 1250, well, you will lose the share. You would get to keep the income on ET here. You would get to keep the $29 in premium that you made plus the dividend if there was a dividend payment, and you would get to keep that, but you wouldn't. But you would have to buy in at the new higher cost. Instead of 1170, you'd have to pay 1250. And so ET's kind of low price, so 1250 wouldn't be just a staggering amount. But if you bought here at 100 and it went up to 111, well, now you're going to have to pay 11,000 versus 1,000, so or versus 10,000. So you can see what I mean by that. If it goes up past your strike price, you do have a little better downside protection. And you can look at the total appreciation amount. Is the capital appreciation between what the current price is and the strike price that you would be selling at the 30 delta? Is that enough? Is there enough of value there to justify selling just the 30, or is it better to sell the 50? Depending on what your goals are and what you want to have happen, or if you want to keep the shares, the 50 delta makes a lot of sense, but you are going to have to, take the trade-off of, you'll collect the higher premium and 52%, over the course of a year, but you're probably going to get assigned. You're probably going to have to repurchase those shares at a higher cost, and there may be some tax implications there. It may even be advantageous. You'll see here in just a second. It may even be advantageous for you to sell in the money if you do have a large account. If you did have a $275,000 account, it may be worth your time to take the premium, but take the loss on the shares. So you sell the in the money strike at 40, and so you lose $899, but you made $1,500 on the premium. So your net profitable, but you don't have to kind of deal with the tax implications of the larger amount that you invested. So hopefully that made sense. Let's see, some stocks are growth only, capital preservation. So I just put that in there. Like, for instance, SPLG, it's a low income stock. I think another one that we looked at was Texas Roadhouse. Texas Roadhouse, I have that in my portfolio simply because I think it's going to grow over the long term. SPLG is more of a capital preservation. It's not a highly volatile stock. We can look at it here just so you can kind of see it. SPLG, I've made $3. It doesn't make me much. It doesn't do much from a growth standpoint. It's the S&P. That's SPLG is just kind of a cheaper SPY. SPMD is another one that's not really a growth stock. Maybe a little bit of growth, but it's the mid cap. And then SPEM is the emerging markets. I've got some emerging markets in here. Again, they're more of a capital preservation. You can see SPEM actually does pay a decent dividend at 2.69%. But every asset you have in your portfolio does something a little bit different. So when I created this portfolio, I wanted to kind of, both get a diverse portfolio of companies that I think will be there over the long term, and I wanted to kind of get some things like bonds. That's strictly you're looking at a little bit of income in dividends, but bonds are supposed to be less volatile. I can tell you this year bonds have been a little more volatile, and so I am down on that position, but that's neither here nor there. And then let's see, 50 delta, usually less than 1% away. So I already talked about that. So you're probably going to be assigned. I personally avoid selling in the money, but like I said, if you're looking just to collect the income, you want to take this $29 and sell this for a $10 loss. Well, you don't have to worry about you would be able to write off the $10 loss even though you had a net profit. So it's something to consider if you have a large account. That was, of course, a small dollar amount example. Key point, what if price declines? And I've talked about that 10 times now. If this price declines, well, then none of these numbers make sense, because if you don't have companies you believe in and this price doesn't, if it declines and comes back, it's really neither here nor there. You're still collecting the income. If it declines and never comes back, well, you're not able to continue earning 24% on top of this amount of money. So you're not able to continue compounding the same 35,000 over time. Now, if this 35,000 goes up to 60,000 by itself, and you've got 5 years of income, 8,000, then 12,000, then 18,000, 24,000, whatever it is, now you're compounding on top of a larger value here. So that's when you get to the 2 million or the million over the course of 10 years. Key point, what if price declines? Share value will fall, but all income will continue as long as the company remains viable. So as long as you believe NRG is going to be here in 10 years, then whether the price today goes down or whether it goes up, like in the case of Intel's traded down, I think from its high around $60 a share. I mean, it's over 50% down. But I think long term, I think Intel will go back to that level or somewhere near it. And I didn't buy in at that level. So really, it doesn't matter. If you constantly average down, it really doesn't matter what the high point used to be, as long as you get your average cost per share down to a number that you're happy to own it at, then you're okay. I avoid the 50 delta because if price rallies, it could mean buying back the shares at the higher cost. The higher cost means this would be a higher number invested, which means you could lose more. It just takes long. If instead of 35, this was 75, well, there's 75,000 or there's 30,000 more there, or 35,000 more of potential losses that you could endure. And so that's kind of all I mean by that. Reality is, if price declines, you would have a smaller total value. So, and I've talked about that 100 times. You would have, I'll read it to you word for word, is if price declines, you would have a smaller total value with which to compound from. So some or all of your income would be eaten by the losses. So if you had 35,000 and this shrank to 30,000, well, it doesn't matter if you made 1,000 in dividends, your losses are still going to be bigger than your gains. And so it's just all I'm saying there. However, stable companies should help mitigate that or even avoid that risk altogether. So if you have good companies that you believe in long term, even if they go down by 50% like Intel has, if you think they're going to go back up, then it's really just a temporary kind of blip on the radar. You're just kind of focused less on the amount that you invested and more on the income. And the overarching goal is to have enough income from options and dividends. So like I just said, you focus less on the total amount you have invested and focus most of your energy on creating a high return or a high income. And then you do that over the course of 5 to 10 years. And then Intel does, hit their stride again, and people start believing in them as a company, and they start making some good business decisions. And before you know it, this share price isn't $28 anymore. Now it's $75 per share. And so your total is only higher. You're earning the same 22% on that. The only difference is now 22% is a larger dollar number. And so it just, kind of all plays in together there. But again, very hypothetical in nature. I know this video was long. I appreciate it. If you watched all the way to this point, I hope you enjoyed it. I hope it added some form of value. I hope you're able to gain something from it. It's kind of the way that I'm looking at my portfolio going forward. I showed you in the last video kind of over this past year, I've kind of showed you what the dividends and the options income has looked like. I anywhere from $100 to $200 per month is kind of where I've been this year. I'm looking to take that from 100 to 200 up to 200 to 300 in the next year, and so forth and so on. And I'm also not going to adapt my portfolio. I'm going to keep most of these companies as long as the numbers that I look at still make sense for me to do so. But what I may do is start portioning off some of the money that I invest each month to get 100 shares, get a basket of companies that I believe in, similar to the ones I've created here, and start earning this, 7 to 8 to even 18,000. Maybe even some variation of, sell 30 deltas on some, sell, on the companies that maybe I think are weaker, sell the 50 delta to even boost the income even further. And so just focusing on the income, the dividends, and the options yield, and just seeing where it lands me at the end of my investing journey. But again, thank you for sticking with me. I really do hope you've watched all the way to the end. I hope you've gained something from it, but I appreciate it. If you haven't already, please do consider liking and subscribing to the channel. It really helps me. I appreciate it very much. God bless each and every one of you, and I will see you in the next video. Take care.